here in Jacksonville. We have about 9 offices and a number of our lines of business that are also participating in this, and looking forward to hearing a little bit about what we believe is very important. Insurance, as you know, is very common across the state of Florida. It is something that most of us deal with in our personal lives and in our business lives. And especially here at our bank, it's something that we deal with just about every single day. So it touches many, many facets. We felt it was important enough to do a webinar on insurance and the state of the insurance market and what's going on here in Florida. And we do have an expert in Nick Napoleon, and we're excited to have him here. Known Nick a long time. He's been in the business for over 20 years. He is a partner with GHG Insurance. GHG is a local firm here in town, but they're affiliated with the Solid Group. It's a big division out. I believe it's headquartered in Orlando. So definitely has the resources there from a bigger group. Nick graduated from University of Georgia. Fun fact, he played on the golf team there, and then shortly after was in Q school, which for those of you that like golf, that's kind of like the minor leagues, I guess you could say. So Nick has been a big supporter of our bank. He's been here since day one. So he knows what we do every single day. He knows the challenges that we face out there with insurance and so forth. So Nick's done a great job with mutual clients over the years, and we're happy to have him here. So without further ado, I'll turn it over to Nick Napoleon.
Thanks, Phil. I appreciate it. Should advance maybe a couple slides?
Okay.
Probably the next one. Insurance has been a kind of a pretty big deal in Florida here recently. As Phil mentioned, I've been doing this for about 20 years and a little over 20 years now. And for the longest time, insurance was something that people talked about, or they pulled their policy out and would read it when they wanted to go to sleep. Unfortunately, the last couple of years here, it's been the thing that keeps you up at night more so than puts you to sleep at night. So the tide has definitely changed on that. It's always been a fairly cyclical industry, but I feel like the last couple of years we've probably seen some of the most extreme peak in the cycle, if you will, from an insurance standpoint in property specific to Florida, auto insurance in Florida, and we'll get into some of that here. We can advance through these bullets. That'd be great. Sure. Oh, maybe one back. National trends, bullets. There we go. Thank you. There was a good article that came out earlier this year in Wall Street Journal, and I thought had some interesting stats. And there's been, I mean, if you guys are into reading the news and that kind of stuff, you probably have seen insurance articles almost every week. There was another one in the Times-Union just yesterday, I believe, that touched on some of the insurance problems that we've got in Florida. But some interesting stats. In 2022, State Farm had a $13 billion underwriting loss nationally. So what that is $13 billion of loss compared to their expenses and premiums that they derive from the policies in 2022. So that's huge. There's another factor that comes into play with insurance companies, and it's investment return. So this doesn't count in their investment returns, but 13 billion straight loss from underwriting policies. That's pretty significant. In 2023, U.S. insurers collectively had a 32 billion underwriting loss through the third quarter. So that's 7.6 above even where 2022 was. So we're seeing this as a national trend. We're seeing car insurance rates going up dramatically. We're seeing homeowners policy rates going up dramatically last year and into this year as well. One more. So why is this happening? Really, one of the biggest factors is the natural disasters that we've seen. Wildfires, hurricanes, tornadoes, some of the flood exposure we've seen. I mean, there was a typhoon that hit California last year, I believe, for the first time in like 100 and something years. So there's just kind of crazy weather events that are going on, and that impacts all these lines. It impacts property. It impacts our flood insurance, which is often backed by the National Flood Program. And it impacts auto. You wouldn't think it would impact auto as much, but when we have these hailstorms, we have significant damage to cars, which is driving that auto rate as well. Over the past 5 years, we've experienced an average of 18 natural disasters that have exceeded $1 billion. Each of those have exceeded $1 billion. 2023, I just saw some data on 2023 that closed out. 2023 had 28 natural disasters that exceeded 1 billion in losses. Comparatively to the 2010s and the 2000s, we had 6.7 disasters. That doubled in the 2010s, almost doubled to 12.8, another 50% increase that we're seeing here in the 2020s now. So it's just the size of these storms, the financial impact of these storms is increasing at a dramatic, rapid pace, and that's impacting the insurability of lots of the things that we have. So these inflationary pressures that we're seeing and what's driving some of these increases in costs, construction cost increases. Everyone has seen this, right? Projects that you used to be able to get done for $400,000 is now $800,000 or $1 million. It's the increased cost of construction has been dramatic over the last several years. Vehicle repair costs. We had a lot of supply chain shortages with COVID. That's kind of continued on, and we're seeing significant increases in cost to repair cars. The technology in cars now, a bumper claim used to be a couple $100, $300. Now we're seeing the sensors in bumpers. You know, you run into the back of a Tesla, you're probably looking at $5,000 just for a little bump on their bumper, because all of that stuff needs to be replaced and recalibrated. But we're also seeing significant increase in verdict sizes. So on the liability side of things, when something goes wrong and there's a claim of negligence against a party, you know, the days of $50,000, $100,000, $200,000 for these are gone, and some of these claims are going for $1 million, $2 million, $5 million. My first probably 10 years in the business, I don't know that we had too many claims, if any, that I can think of that exceeded the primary layers and went into the umbrella. And just this year in our office, we've had a $6 million claim, a $5 million claim, and probably another one that's going to go for policy limits, which is going to be $5 million. So we're even locally seeing the size of these claims dramatically increase from where they were 10 and 20 years ago. Where does this take the insurance companies? Insurance companies they're not really in the business of taking risk, right? They want to understand what it is that they have out there, and they want to write it in a mass that they can predict the outcome. And so when we have these dramatic shifts in what they're looking at, the data that they're seeing, it has a cause to pull them back to become much more conservative than they otherwise would be. So they're increasing reserves on accounts and across their books of business to take into account this volatility. The reinsurers, carriers buy reinsurance, which is insurance for the insurance companies, and the reinsurers are seeing this as well. So they're having to drive their premium costs up to account for this unpredictability that's coming through. So all this leads to premium increases for the consumers that at the end of it are buying the policies. So I wanted to talk a little bit, these are some national trends, a little bit about Florida specific. Personal lines is a good place to start because it kind of leads into the commercial side as well. From May of 21 through 23, homeowners rates have increased 68%. And you used to be able to go out and get a homeowners policy for $1,200, $1,500. Now it's $3,000, I think, is the average across Florida. And there's many segments where you're seeing $5,000 and $6,000 premiums in South Florida and coastal regions as the average cost for a homeowners policy. We've had, I think, 12 or 13 homeowners carriers go out of business in 2022 and 23. Some recent good trends in that is we've actually seen, I think recently I saw 9 new homeowners carriers enter the market. So we're going to talk a little bit about at the end kind of where this is all going, but we are starting to see some good signs. One of the more recent big losses for the state of Florida, though, is Farmers. I'm actually a Farmers policyholder on my home. But they're dropping 100,000 customers across the state that started at the beginning of this year. Luckily, my home renewed in December, so I actually get them the benefit of staying with them through the end of this year. But I'm going to have to find a new home at the end of the year, as so many across the state are. So we talked about some of the national cost increases in auto. State Farm and Progressive, specific to Florida, raised rates last year 30%. We're seeing these renewals come in daily from Progressive, and we're constantly having to try and look to see if we can find better solutions. Sometimes we can, sometimes we can't. USAA, one of the longtime stable, great carrier that insures many of our military, rate increases of 34%. They take that pretty seriously. You don't see that type of reaction from a USAA. So when you see a 34% rate increase from USAA, you can tell the state of the market's in pretty significant poor shape. Liberty Mutual, huge insurer in the state of Florida, 44% rate increase. A lot of you may know that as Safeco. If you've got a personal policy with Safeco, that's a part of Liberty Mutual. So 44% rate increase there. Another little tidbit here, a recent article I saw, recent filing, Citizens is has really grown in homeowners policies across the state of Florida, and they've filed for a 13.5 rate increase for this coming year. So a lot of the Citizens policies, we're starting to see some competition, so some good things. Maybe some of those policies will be removed from Citizens here in the coming days and months, but we are looking at more than likely some significant increases to even Citizens policyholders, which is the market of last resort, the state insurer. Why is Florida so bad? We're basically ground zero for catastrophic losses in Florida. 2017, Irma had a $77 billion financial impact. Hurricane Matthew in 18 was a $25 billion impact. Ian in 2022 was staggering. $113 billion event, estimated insured loss of $50 billion. Florida alone was 1/6 of the catastrophic losses in 2022 globally. So why is Florida so bad? Why would anyone want to come here and insure Floridians, right? We are ground zero. Next tab here is that some more reasons why Florida is not the greatest place. Some good news on the backside of this, but we'll talk about it in a minute. But there's some things that have been going on for a number of years here. Assignment of benefits you may have heard of. This is where contractors are coming in and getting a homeowner or a business owner to assign the benefits over to them of their insurance policies and represent them on the claim. That sounds like a great deal. You don't have to worry about it. You give it to your roofer, he's going to take care of it. But what we're seeing is a lot of fraud behind the scenes on that, a lot of litigation that becomes a part of that. So $20,000 roof replacement. Now all of a sudden the carrier is getting pictures of all this extra work that had to be done that they uncovered when they took the roof off. Well, the carrier never even had a time to inspect that and adjust the loss. They're just getting this supplemental bill from the roofer for an extra 20 grand. So we're seeing a lot of that. We've seen a lot of that type of stuff over the last few years. And the litigation related to those is really driving up insurance costs for Floridians. 2021 saw 116,000 lawsuits filed against homeowners insurers related to claims. It's a staggering number. I mean, I wouldn't have even guessed that there would have been 116,000 homeowners claims in Florida, let alone litigated claims. We're 9% of the policyholders nationally, and historically, the last couple of years, we've had close to 80% of the national litigated claims. So that's just all adding to the claims cost. You think the claims cost is really just, we're going to pay the $10,000 to have your roof replaced if there's a roof issue. But when there's so many litigated claims, the expense on that $10,000 roof could easily be $30,000, $40,000. And the carriers just have to end up passing that along to in increased rates to the policyholders because they're having to deal with it. It's a reality of the expenses of them adjusting a loss. Kind of a little bit of data here. We talked about verdict size. Personal injury cases, 39,000 was the average back in 2010. 2020, that data was 125,000. So a tripling in a 10-year period of time. It's a little more than our 2 to 3% inflation that we like to see, right? Some auto-specific stuff. We're the 4th highest theft rate for vehicles nationally. Florida is. A lot of that's in South Florida, but it's up here in Jacksonville, Orlando. It's kind of across the state a little bit. An interesting stat I saw kind of coming out of COVID was the telematics is the GPS devices that are common in vehicles now. A lot of commercial fleets have the GPS devices. A lot of the carriers now, Progressive, State Farm, will ask to have the GPS in your vehicle for a discount. Well, they're getting a ton of data on this now. So before COVID compared to after COVID, they're seeing a 23% increase in screen interaction time. So a lot of times this data is being collected off your cell phones. You've got an app on your phone for State Farm or Farmers or whoever it is. Well, they're collecting that data and they're able to tell when you're on the screen when you're driving down the highway. 23% increase in that. So that's driving auto accidents, and that data is discoverable. So when they figure out that you bumped into someone, your Tesla guy that you ran into, that you did $5,000 in bumper damage, well, you happened to be on your phone at the time, and he's got a little bit of a sore neck. So now the pediatric physician is asking for $1 million. That's a real claim in my office right now. So it's just a compounding effect of a lot of different things that are going badly here for us in Florida, and that's what's driving the inflation that we're seeing. In many of our policies specific to property, the perfect storm of 2023. 2023 is really the worst year from a property insurance standpoint that I've ever seen, that anyone that I've talked to in the industry has seen in 40 plus years. Worse than Andrew. It's even 2005-06 when we had those hurricanes, 4-5 when we had those hurricanes, we had some dramatic spikes in property coverage after that. But this is even worse than those timelines. There was a carrier that insured a ton of business in Florida, a lot of apartment complexes, condominium associations, so that multi-habitational stuff. AMCAP. They went out of business in 2021, and obviously the problem started before that, or they wouldn't have gone out of business. But they had probably, I would suspect, probably 500 million in premium volume on the books. So trillions of dollars worth of values, more than likely across the state. And that, to me, is really what started the ripple effect on the commercial side of things from a property insurance standpoint, because you saw that huge shrinkage in capacity in the marketplace, and the rest of the market had to react to absorb that. And it's just simple supply and demand. There wasn't enough capacity out there to meet the demand from the marketplace. At the same time, you've got increasing values from construction costs, which are driving up the value of insurance that needs to be purchased. You've got a shrinking capacity to insure these values. And so we saw just staggering increases in 2023 renewals, 300% rate increases. I had 1,000% rate increase on one piece of property that was not renewed. It was just catastrophic in 2023. We're starting to see things turn the other way, which is good news. We'll get into that in a second. What the carriers look for now, they've become much more sophisticated in really delving into what risks they want, what they don't. And so it really boils down to this age, location, and construction. So they have a lot of statistics from all these hurricanes that have come through, and what buildings perform well, what locations perform better, what the age cutoff is, and that deals with the code changes over time and the construction style of the buildings. So they kind of have it dialed in. So when you get when you get buildings that are older than 2000, when you get locations that are coastal, the lighter metal construction, the wood frame construction, it's kind of obvious to some extent, but they certainly have the data to back it up that those buildings are not performing as well when the storms come. So it becomes very difficult at times to find coverage. We have a lot of clients now that choose not to buy wind coverage just because of the characteristics of their building and the location. It's not affordable or not even available in many instances. And we've talked about the building valuations driving a lot of this as well a couple times. But so that the cost increases, the availability of coverage in the personal as well as the commercial market was really a big challenge in 2023. A little bit broader on the commercial, that's kind of the property specifics of it. Auto insurance has been probably number two. I mean, I would say auto insurance honestly has been right there with property. It's just been a longer process to get to where it is today. And the prospects are probably equally as dim as the property marketplace potentially is. Um, Light local service, so your F-150 pickup truck that's going out and making a few stops during the day, that's going for $6,000 a unit up here in Jacksonville now. 15 years ago, that would have been 1,200. 10 years ago, that might have been 1,500. 5 years ago, that was probably 3,000. So the acceleration of cost increases in that auto insurance marketplace is crazy. It's even being picked up nationally on the CPI data. It's like number one, I think, one of the recent reports that came out, 20.6% increase from January 23 to 24, inflation in the auto insurance marketplace. So honestly, I don't really know what needs to be done in the auto marketplace, but we're really not seeing any relief in sight. A couple of my renewals here recently had 20 to 35% rate increases on auto. If you've got a couple claims that have come in recently and you've got a fleet, it's probably not going to be a pretty renewal. General liability has overall been pretty good. We've seen more inflationary increases there, kind of 3-5%. Depending on the industry, though, there's a couple hot industries. Hospitality has been a recent challenge, and habitational has been a big challenge here recently. Condo associations, apartment complexes on the hospitality side, on the habitational side, I used to see condos go for $18, $16, $18 a door for general liability. We're probably in the $75 a door range now. Your apartment complexes, a nice apartment complex, we used to see $50 rates per door. We're pushing $150 a door now. And we've seen a lot of pullback in coverage, firearms exclusions, animal exclusions, assault and battery exclusions that are creeping into those policies as well. So it's getting harder to find the coverage that you need to properly protect yourself, while at the same time we're seeing dramatic cost increases as well. And that's really the same in the hospitality environment as well, probably a doubling per unit for a hotel. Restaurant increases nationwide just pulled out. Earlier this year, they pulled out for the most part of the restaurant business, and they had a ton of restaurants on the books. So some of the restaurant accounts that we have with Nationwide were delivering 40-50% increases on general liability rates, because the next best option is just that much more expensive than what Nationwide was charging. And Nationwide looked at it and said, we can't afford to do it at this rate, so we're out. So that's kind of what we're seeing in those couple instances in general liability. But overall, most industries are in pretty good shape from a GL standpoint. Excess umbrella, we've talked about some of the increases in claim severity and really piercing and hitting those umbrella limits. A lot of large losses out there, and that is really starting to drive the excess umbrella market. A lot of it is auto claim related, but we're also seeing it on just large general liability claims as well that are piercing into that umbrella layer. So we're definitely seeing, 10, 15, 25% rate increases on umbrella year over year, just depending on the specifics of the account. We'll save some of the better ones here towards the bottom. Management liability, your D&O, employment practices liability, has been a very competitive marketplace. Cyber, we had a big spike in cyber premiums and capacity in the marketplace in kind of 2021 into 22. That's changed. There's been a lot of capital kind of flowing back into that cyber marketplace. And we're starting to see improved terms and conditions and significant reductions in pricing in that, and increased availability of limits as well in that cyberspace. So some good news there. Within that realm, that management liability realm, a lot of times you'll see abuse and professional liability. Abuse is kind of your abuse and molestation coverage for a church or a nonprofit dealing with kids. That's been a very challenging line for the last 4 or 5 years plus, probably continues to be a challenge. And some of the professional liability areas remain a challenge depending on the niche. We had the collapses of the condo down in South Florida We had the bridge collapse down in South Florida. So if you're an architect or an engineer, you're probably having some challenges on your professional liability compared to where you were 5 years ago. And then workers' compensation has really been the one that's been great in Florida here. Kind of when I got into the industry back in the early 2000s, we were in that crunch of workers' compensation where we saw the ramp up of pricing. The state was increasing rates multiple times a year to try and keep carriers on board with staying in the marketplace. Probably peaked out in 04, 05. And then from there, we've been in a downward slide. 50% decrease over the past 15 years, 70% decrease in rates over the past 20 years. So that's probably the one shining light. Workers' compensation renewals are great these days, and we haven't really had too many difficult conversations on that line in a number of years. So that's been good. I think there's been a reduction in claims activity there in general. You would think increasing medical expenses, which we all hear about every day, would be driving that workers' compensation premium up. But they've been able to control costs within the programs the carriers and their networks have. And there's just been a decreasing frequency of incidents with most employers. So things are trending in the right direction on the workers' comp front for sure. Let's see. Wanted to touch a little bit on some of the tort reform that we've had last year. So this is kind of getting into some of the good news and kind of where we're going from here. There was a couple bills passed. One was more related to construction. One was more related to general negligence. So HB 837, we're starting to see some impact from this now. And comparative negligence threshold is at 50%. It used to be prior to this where if someone claimed negligence against a party, they really only had to prove any little bit of negligence, 1%. And that party would be responsible, if they were able to prove that, would be responsible for damages. Now there's a much higher threshold. You basically have to be able to be 50%. You have to prove 50% negligence of an at-fault party is the theory behind this now, before you're able to collect on those damages from that at-fault party. So I think that's going to help a lot. There's been some kind of standardization in calculating of medical damages. There was a lot of, I wouldn't say fraud going on in that space, but the way some of these claims were being adjusted and the way some of the plaintiff attorneys and medical treatment was being provided to injured parties was really ramping up the costs of medical treatment prior to even initiating a claim against the carrier. And it wasn't necessarily discoverable how they were charging that from an evidentiary standpoint. So we've all seen this. You get your bill, you go to the hospital or you get treatment for something and you get that initial bill from the provider and it's $1,000 for a service. Well, you turn it into Blue Cross and you see, on your Blue Cross statement that they paid $178 for the same thing. Well, so, that's where we're bringing that standardization in, where what the actual amounts that are typically paid for those services are what is going into the litigation, not the inflated values, which is what they were able to utilize before in many instances. So definitely some changes here that we think is going to help reduce liability frequency and severity of these claims. It just takes time for the carriers to really be able to get their arms around this data. I mean, they can see that this is going to be helpful, but they really are in the business of understanding and being confident before they put out their policies and can price it properly. So it's going to take a little bit of time for this to trickle through before we really start to see more competitiveness in the marketplace. But I think this can certainly help us in that hospitality space, that it can help us in the habitational space as well, some of this tort reform. There's some specific reforms in here as well for that habitational space related to site security, negligent security. If you meet certain standards, you've got training for your staff, you've got camera systems, you've got adequate lighting for an apartment complex or a condominium association, as an example, it modifies that premise, that liability standard you're presumed basically not to be negligent if you meet certain standards. So it's a much higher burden for a party to make a claim against an apartment complex owner, as an example, if they've met these standards. So we think this is going to help. Time will tell, but we think this is going to help. SB 360 is really more your construction focused. So construction defect litigation has been a big challenge in Florida for a long time, especially in the habitational space. So if you're building homes, especially if you're a subcontractor for one of the large national builders, you've experienced this firsthand. But the amount of litigation, the number of parties, because of the way those contracts are worded, that are being brought into litigation for construction defect issues has been, it's astronomical. I mean, we have a couple of clients that a trim contractor, his loss run report is probably 3 times as thick as that because he's doing work for those big builders. And when the construction defect claims come out, they name everyone who set foot on that property in the suit. And so he's having to defend every house that he put trim in because it has an issue. And they're paying those claims just to get out of them. You get 50 attorneys in a room and they're all like, can I get out of it for 10 grand? And so that's what his loss run report looks like, all these $5,000 and $10,000 to get out of these claims. So there's been a lot of changes in this. The statute of repose, which is the timeline for them to be able to make a claim after the fact, it's been reduced from 10 to 7. The commencement date is a big deal. You go into a large community, let's say there's 500 to 1,000 homes being built. The commencement date prior to this could be, they were arguing that it could be deemed when the last house in the community was constructed. So you can have a project that took 3 or 4 years to build. Well, now instead of the 10 years, that first home in there is getting 13, 14 years of ability to go back against the contractor and all of the subcontractors for construction defect related issues. So there's definitely some nice changes here that we think is going to help improve that construction defect litigation, and it should help with our trade contractors and home builders that are out there, and multifamily stuff too, building condo complexes, that kind of stuff. So some good things in the works here. Kind of what to expect the rest of this year and going forward. We're definitely seeing some stabilizing this year. So some of those 300, 500% increases we saw last year, we're starting to see some decreases now. It's not, the $35,000 policy that went to 115 is not coming back down to 35, but we're starting to see that shave down to maybe 95 or 100. So it's at least moving in the right direction on the property front. The tort reform is going to help, but we still have hurricane risk in Florida. There's really no way around that. Unless we're, really willing to take some strong stances on construction style, construction locations, we're definitely going to have problems for the foreseeable future. I think we may differ on opinion as to why, but I think it's pretty obvious. I think everyone's pretty much on the same page that we're seeing more severe storms. We're seeing more severe weather across the country, especially here in Florida. And that's definitely going to continue to impact us from a Floridian standpoint as far as being able to insure our properties. So the things we can do to build in the right locations and to harden our investment to reduce its risk of being damaged are going to help us in the long run. So I'm a little out of date here. I said 9 new homeowners insurance recently announced plans to enter the market. So those 6 are now kind of in the market. We just recently heard of about 3 more that are coming online. So there's definitely some increasing investment, provided the wind doesn't blow. I think we're moving in the right direction. I think the market overreacted to the challenges that we had over a couple of years. The tort reform should help a little bit of that, even on the property side. And I think we're starting to see that competition return to the market. And I think that's going to help us with some great relief here in the next coming years, provided the wind doesn't blow. So that's kind of all I have for you today. So I'd like to open it up to some questions if there's anyone out there that's got anything.
I've got a question. First of all, great presentation.
Thanks.
Very, very concise and eye-opening. We see a lot of requests at the bank to waive windstorm, either it's just too pricey, and in some markets, it's just not available. Why don't you speak to the group why that's a bad idea? Sometimes we've been able to find workarounds, but, I think some of the times the argument we get is, well, my property is well inshore and, I'm not near the coast, so I don't need windstorm. I guess I think of, in terms of windstorm, I think of, well, yeah, I get it, a hurricane's not gonna blow over a structure this far inland. But what happens with hurricanes, you also have tornadoes been involved, and to me, that's probably the risk. So
Yeah,
for a layman, like most of us who don't understand insurance very well, talk to us about windstorm and why it's a bad idea to, not have it.
well, I mean, I think in general, banks are probably pretty similar mindsets to what insurance companies are, right? They want to understand the risk and they deal in large numbers with small margins to make a profit.
Right.
Right? So if you're adding additional risk to your loan, your portfolio, by accepting not having wind coverage, then do you have the ability to underwrite for that? Can you price that into the loan across your portfolio to still maintain profitability? So if you have a significant event and you've got 5-10% of your loans out there in your portfolio that don't have wind coverage, and these folks are in a bad position, they're not going to be able to maintain their business operations. They may default on those loans, and you're not even really going to have anything from a collateral standpoint to back that because the building's gone.
Yep.
So, I mean, that's kind of my sense of it is, it's small margins, large volume is what makes a bank work. That's kind of the same in the insurance world. They want to be able to predict what's going to happen, and they're going to do it on a large scale, making 4 or 5% return on it, and that's going to generate their profitability. They want to understand and they want to minimize risk wherever they can, and I think that's the same in the bank scenario too. So it's hard, it's a hard balance because we're seeing it from our perspective too, and we have clients that, if you've got a 1970 metal building that's east of 3rd Street and doesn't have a whole lot of updates, I don't have anyone that's going to insure that for me. So, it just is what it is. So that puts you guys in a bad position of saying, how are we going to handle that? What's our forced place situation look like?
Yeah.
Is the client going to be tenable to that? So definitely some hard conversations have been had, I'm sure, over the last couple of years for you guys, and I'm sure it's continued into 24 and will probably continue into 25.
Thank you, Jim. Looks like we have a question from Tony Martinez.
I apologize. The question was answered in response just now. Thank you.
Thank you, Tony. Nick, I hear a lot about the difference between, or what is the difference between cash value and replacement cost? If you can help us understand that one a little better.
Yeah, we're starting to see, this is a kind of a change in terms and conditions that we're seeing. It's always been out there, but we're seeing more and more carriers wanting to offer actual cash value, especially on older roofs and things like that. And so actual cash value takes into account depreciation, where replacement cost is new for old. So a 30-year roof that's 15 years old, if we have a claim issue on that, and the policy is set up on an actual cash value basis, they're only going to pay half. It's 15 years of its 30 years, so it's halfway through its life. So the carrier is on an actual cash value basis, is only obligated to pay half of the loss. And you also have to take into account your deductible too. So they're actually going to get less than half in that scenario. Replacement cost is new for old. So that same policy has replacement cost benefits to it. They're going to adjust that loss on a new for old basis. So even though the roof was 15 years old, it's halfway through its useful life, you're going to get a brand new roof factoring in your deductible in that claim scenario. So good question. So something important to look at those policies when you're buying them is, what are the terms and conditions? Little things like that can make a big difference.
Nick, thank you for answering that. We have another question from Maria Hayden. She wants to know, in general, what could we expect from a percentage increase on her liability coverage in the next 12 months or so?
So really, very specific to the industry. So it's hard to say. I'd be happy to talk to you offline if you're looking for some budget numbers. I could, kind of give you some guidance on that. But if you're in the hospitality space or you're, maybe a property manager representing some properties, you're probably going to see some pretty significant increases. If you're a manufacturer or a distributor, a Main Street type of a business, you're probably going to be pretty much where you are now, maybe more inflationary increases, 3%, 5%. So you shouldn't see too much there. One of the things that is impacting general liability premiums a little bit to touch on is that with some of these cost increases, everything has inflation, right? A carrier is looking at a general liability policy, and oftentimes it's based on sales. So if your sales are up, you may not have sold more units, but your price per unit is up 20%. So your sales are up 20%. Well, the general liability carrier may have only given you a 3% rate increase, but your premium is going to be up 25% because 22%, whatever the math is on that, just because your cost of what you sold is more. So there's some of that kind of hidden inflation within the insurance premiums that we don't see. And I definitely get that, argument from some of our clients too, is, hey, I didn't sell any more units this year than last year, but my revenue was 6 million instead of 5 million. So now all of a sudden my insurance coverage is more costly. So.
And I think, lastly, if no one else has any questions, I think we've got one more. Sherry Huey.
So I do a lot of construction monitoring, construction loans.
Yeah.
So is it a true statement? You have builder's risk, you get a CO. Does the builder's risk no longer in place? You have to get hazard, or some of the builder's risk will lap over a certificate of occupancy?
So it depends on the carrier. It's definitely can be case by case basis. So US Assure, which is a local company here in Jacksonville, it's a Zurich-based product. They have a huge builder's risk program. And their kind of standard policy form is you've got about 60 days after CO to get permanent placement, standard placement in place. And that builder's risk is going to expire at that point in time.
Regardless.
The policy date may be 9 months.
Right.
But if you've got that CO, your clock is ticking and
Okay.
you need to be planning for that. But other carriers will offer full occupancy on it through the policy expiration date. So if you finish the project early, you can keep it in place until the expiration of the policy.
So it's truly case by case.
Yep.
By the carriers. Okay,
Mhm.
thank you.
Yep, AmRisk is one. We do a lot of builder's risk with AmRisk, the AmRisk program out of
Mhm.
Texas. And they have full occupancy on their program. So you just ride it to the end of the policy term.
All right, thank you.
We have another question from Dennis.
Yeah, hi, thanks everyone. I'm in my company's in the semiconductor business, and so we buy critical semiconductors for investment grade type companies. We provide storage and fulfillment of those semiconductors over a period of time. We were with Century, SENTRY for 20 years, never filed a claim. And then Century came back to us, and then we learned from some other carriers where they're limiting how much inventory coverage that they will provide for a customer. So they reduced theirs to just $5 million. Well, I'm currently holding about $100 million of semiconductor inventory that I had to insure. So had to go to companies like Lloyd's of London to fill the gap. I'm working with WTW, one of the larger carriers in the nation, or brokers, I guess, in the nation, to try to do something about this. But I didn't hear you talk specifically about inventory unless it falls under the general liability. And I'm just trying to wrap my head around, because these costs have maybe doubled for us. And I'm trying to wrap my head around why companies are moving away or limiting the amount of inventory coverage that they provide for their customers.
Yeah, that's a good question. And it could be, you could be in that ocean marine space on like a stock throughput type of policy, or it could just be contents built into your standard property policy with Century. But either way, we're definitely seeing significant capacity shrinkage in that area. And it's just, we talked about property, and a lot of times people just think building coverage, but it's not just the building coverage, it's the contents, it's the inventory, it's the business interruption coverage, all falls under those property policies. And so, We certainly have a lot of clients that, were buying 10, 50, $100 million in limit last year, and the market just wasn't willing to give that. Back in 2023, we'll see as these renewals come through in 2024, we're having more luck in that space. Carriers increasing capacity. The standard carriers like a Century are going to be typically slower to react and slower to come back. So that's where you're talking about some of these Lloyd's markets and, RSUI and some of these other non-standard players are much more nimble. So that's probably where you're going to see your capacity in the near future is in some of these surplus markets, but it's going to be costly. It's not going to be as cheap as what Travelers or Century or CNA is going to be willing to offer, or Liberty Mutual. So you're going to have to kind of wait, unfortunately, probably for these standard markets to return to the marketplace before you're really going to see premium savings in that line. And you're going to have to make some tough decisions on what's the appropriate coverage. Do I want to buy the full 100? Can I afford to buy the full 100? Do I cut it back to 50? Do I buy a $25 million loss limit? Can I build that in some way in partnership with Century where maybe they're taking the first 5 and I can build on top of that at a cheaper rate? So, so you're definitely having to strategize and kind of get creative to try and figure out how to protect your assets there for sure. But that's not uncommon. We're seeing that when you talk about capacity issues in property, it's impacting contents, it's impacting inventories, business interruption, as well as the building coverage itself.
Okay, thank you.
Sorry for the bad news.
Dennis, thank you. I appreciate you bringing that up. It's a good question.
Sure.
If there are no other questions, I think really we'll end with Nick, what do you suggest we do on an annual basis with either our agents or our brokers? What would you advise our clients do on an annual basis?
Yeah, I think it's important to be in communication with your agent broker ahead of the game, right? Let's talk to them not just at renewal time, but let's get some budget projections outside of renewal. What's the market conditions look like? What are some of the challenges that we're going to have as we come up? Knowledge is power, and as business owners or homeowners or whatever it might be, you need to have that knowledge to be able to make the decisions in your life that make sense and for your business that makes sense. So I think having that open communication with your agent broker is key, and doing some planning with them to make sure that they understand what your business or your personal situation is. They can adapt to that and put the right products in place, and that everyone's kind of on the same page, that there's a solution that makes the most sense for everybody.
That's good stuff. Thank you. We will have this, slide deck available. We will send it out as well to our markets and our lines of business. If anybody would like one, please let us know, and we'd happy to send it out. It'll also have Nick's contact info on there as well. So thank you so much, everybody, for joining us today. We really appreciate it, and hopefully you came away with something more than you knew about 20 minutes ago. So thank you very much.
Thank you.